Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining our webinar today that's being brought to you by qplum. We're going to have there's a little bit of background there, background distortion. Okay, what I'm going to do is actually welcome our qplum presenters here today to talk more about tactical asset allocation. So with that, I'm going to turn the controls over. Let me actually pass our controls over to qplum, and we'll go ahead and get started. All right, here we go. Thanks very much for joining us, G and Gaurav. Let's get underway. If you can share your desktop, we'll simply get started.
Okay. Thank you so much, Cynthia. Hi. Go ahead.
I do see the slides, so we're ready to get underway. Thanks, G.
Thank you, Cynthia. Hello, everyone. Thank you so much for taking your time to attend this webinar with us today on tactical asset allocation and deep learning. My name is Ji Chen. I'm the head of client relations here at qplum, and we're presenting. Presenter today is Gaurav Chakravorty, who is the chief investment officer of qplum, and his mission for qplum is to make finance fair for everyone. qplum is an asset management firm that makes investing affordable and accessible by using AI and deep learning. So without further ado, I'll have Gaurav present.
Hey, so today we're talking about tactical asset allocation. I'll explain what that means. But just to give you guys some perspective, I've been working on trading for 12 years. But what most of the world cares about is investing. What I mean by that is that most of the world cares about, I have this amount of money. Some of it is in a liquid product, some of it is in brokerage accounts. And how do I invest all of that to achieve my goals, or to do well according to my internal score function, according to my utility function, according to what makes me happy? Now we'll look into that question. The reason why this is important is a central principle in data science is figure out how you will be scored, then optimize for that. Don't make a make-believe metric and optimize for that, and finally you'll fall flat if that is not representative of your business function. So for this next hour, let's imagine ourselves in the shoes of the CIO, Chief Investment Officer, of let's say a large pension fund. Many of the questions we'll encounter are very similar to what individual investors face. What we'll cover today is first they face an asymmetric utility function, just general loss aversion, in the sense that if I make 6% versus 16%, 16% makes me happier, of course, but not as much as the penalty I feel of losing 4% versus minus 14%. So losses hurt much more than gains. The next pain point that investors face, we'll look into. Okay, let me not skip to that section yet. We'll look into pain points that investors face. Then we'll look into the goals of asset allocation, how they try to address those points. And then we'll see this fundamental difference between tactical and strategic allocation. I'll explain what those terms are to some of you who might not know. And I'll explain why strategic just doesn't work. And then we'll talk about how we approach it using deep learning and our results. So again, imagine you're a CIO of a $20 billion pension fund. And you know from the board that if you lose money and you're getting underfunded by losses, that's a huge risk to take. Sometimes there's natural cash flow coming in, either from further deposits, further contributions, or from the business. There's so even if you don't lose money, that's not. If you're not making enough money, that's not necessarily a bad thing, because there are other sources of growth. But if you lose money, that puts you in a lot of career risk. So there is natural loss aversion. Broadly, the concept of utility function has been explored by Harry Markowitz. In fact, in his seminal paper in 1952, he refers to that. Most of the work he has done after he expounded the mean variance optimization theory was on figuring out what to optimize. And in his Nobel Prize lecture, most of it is about this utility function. Daniel Kahneman has spoken about this utility function. So this is a very important topic. For the perspective of an investor, safe to say that gains are better than losses. Very high gains help, but not as much. On the other hand, losses hurt in general twice as more in gains, but the hurt keeps going higher and higher if you lose a lot more. So this is sort of our utility function. Next, for an investor, usually there's, especially pension funds, there's a sustainability rate, which means that if the if the investment is growing at a rate that is specified by the board, let's say 6% is my sustainability rate, then after paying for the demands on the fund, I can still pay the claims in perpetuity. Essentially, that's sustainability rate. And simple job description of the CIO is if I'm meeting that sustainability rate or not. Most of us also look, like even in our personal investing, I think we would also be able to come up with broadly, this is the target rate of growth I have. I would be happy if I were to grow my money, let's say 8% a year. So I think sustainability rate is a very natural concept that a lot of people can use in their investing, but the large investors or individual investors. The reason I mention this is because this is going to be a fundamental input in the optimizations we do later on. Okay, other pain points are, again, as a CIO of a pension fund, you need investments that have scale, that can manage, X many $1 billion, and a trading strategy that can at best scale to a few $1 million does not will not resonate with you, will not provide any benefit, it will not impact your utility function, no matter how uncorrelated it is. So we need strategies with capacity. And like most investors, pension funds as well, have significant allocation to illiquid assets. Illiquid assets like infrastructure, real estate, private equity. It's true that most of these illiquid assets can be modeled as some combination of liquid assets, but they have different characteristics, and you cannot sell them proactively if your model asks you to, since you have to model it separately. As individual investors, we also have a lot of illiquid assets. In fact, I think most of us have majority of our wealth in illiquid assets. Liquid assets for individual investors would be, the house, or car, or maybe even stock in a company that they're working in and has not IPO'd. So a lot of these liquid assets. Okay, at this point we have our first poll.
Okay, just give me a moment here, guys. So the first question of poll 1 is, out of the 4 pain points we discussed, which one is your biggest concern? So please select one, and we'll give you about 15 seconds to decide.
Hmm.
Okay.
Thank you.
So we'll close the poll now, and it seems like...
Yeah, so yeah, you're right. I think most people are answering pretty much exactly what we hear from CIOs of pension funds, that the biggest concern is high aversion to losing. And second, so 52% is high aversion to losing, and 33% to the sustainability rate, that I should be able to make my sustainability, the target rate of growth, that's my sustainability rate. And you know, a distant third and fourth are adjusting for illiquid assets and targeting capacity. Okay. So now, how do we address these pain points? Again, let's think from perspective of, I'm a CIO. I got to, you know, these are the pain points. Great. Now I have to figure out how to work to address them, how to score well against my metric, how to get a good bonus, if you will. So I think it's been documented at many places that asset allocation, or the decisions that one makes at the CIO level of, you know, how much to allocate to different asset classes, that has a much bigger impact than security selection. What do I mean? How much we allocate to, you know, stocks, bonds, real estate, commodities, you know, gold, etc. How much we allocate at that level. And right now I'm talking of allocation in terms of assets. Later on we'll talk about strategies, but let's continue the discussion. How much we allocate to each of these asset classes has a much bigger impact on my end of year return than how I represent these asset classes, in the sense that my allocation to equities, if I'm then further, you know, investing that in Google, or if I'm investing that in bank stock, that has less role to play, because practically a lot of us do come very close to the index when we represent our view in an asset class. So now, restricting ourselves to asset allocation. The reason I introduced the slide before is to first say that asset allocation is more important, and security selection is a whole different ball game that that'll take many more webinars. So let's focus on asset allocation. Okay, again, we are CIO. We have to work on asset allocation. Our goals are in front of us. Our pain points are in front of us. So usually what one would do is they would target a constant risk. They would try to make sure that the portfolio does not lose more than a certain amount of money, does not look overly volatile, it does not, it's not uncomfortable to stick with the portfolio. Okay, so target a constant risk. Second is, as we mentioned, we have to optimize when making the portfolio, we would optimize for a specific utility function, and this would be very, very quantitative, not just a vague idea of losses hurt more than gains. You would exactly say, at a gain of 10%, what's my utility function? A gain of 11%, what's my utility function? So getting very detailed around that. Once I have the utility function, then I also, before I finalize my portfolio, another key point is to figure out the systematic response that I would have to losses, which we also call systematic risk management. Let me explain. A common mistake many of us make is that we see we see just returns of a graph. We don't see what would we have realized given our response to losses. For instance, if you look at S&P 500 returns over the last 20 years, it's around 9%, 9.1%. However, if your risk management is such that you sell and stay in cash for a year, at a drawdown of, let's say, 20%, then under this risk management, if you see your realized returns with S&P 500 would have probably been around 5.7%. So 9.1 is a myth, is an incorrect number. It's misrepresenting what for you this product would have returned. Okay, so again, we are finalizing these aspects so that later on we put these into our deep learning process, the risk management, the yield function, what are the the constant risk as an criteria for optimization, and that's it. After that, what comes out of that process should check all the boxes, you know. Okay, so now at this point, in the past there has been a debate on whether to do strategic versus tactical allocation. Strategic allocation means you make your pie chart, you say, okay, I'm going to be 50% in equities and let's say 25% in bonds, and etc. And you make your pie chart under the assumption that I'll stick to it for 20 years or a very, very long period of time. That doesn't work out. Almost nobody sticks to the same pie chart. And if you look at documented changes, asset allocation changes of large pension funds, it is to a large extent based on past performance. So for instance, last year, Norway's NGPF, the largest pension fund in the world, they switched to 70% allocation to equities, obviously after many years of good performance from equities. So strategic allocation is a misnomer. Almost nobody is strategic. Tactical means changing your asset allocation in a way that reflects your expectation of how well each of the asset classes will do and your expectation of how risky they are going to be. So tactical asset allocation is dynamic, strategic is constant. Now again, one of our simple observations is that dynamic asset allocation does much better for the goals that a CIO office faces, even for the goals that an individual investor faces. But the way to achieve that dynamic allocation shouldn't be, I'll react to the circumstances when they happen. Having a systematic approach to dynamic allocation, to tactical asset allocation, is the holy grail, is what we are working on, and I think is the end goal of this current transformation in Wall Street towards systematic quantitative portfolio management. But okay, at this point we have our second poll.
Okay, for the second poll, the question is, which of these asset allocation strategy will adapt more to changing market conditions? So again, just like we did before, we'll give you a couple of moments to answer. I do want to take this moment to let you guys know that, please feel free to send in your questions, and we will get to them at the end of this webinar session, at the end of this slide presentation.
Yeah, I think this was an easy one. Thanks. As most people correctly predicted. So dynamic asset allocation is about adapting to changing market conditions, and for it to have for it to do well, we have to sort of test how well we are able to adapt to changing market conditions. But okay, so again, as a CIO, my work is to figure out how to change my allocation to asset classes. Okay, what are my goals? Better risk targeting and better performance according to my utility function. So this is where our deep learning work comes in. This is the workflow that we have been working on here, and we are working with large institutional investors to implement in-house. So I'll explain, but what we are talking about, the simple definition of this is, how do you take new data every day and figure out how to change your asset allocation? Okay. So when new data comes in, you code them up as indicators, as sort of, alphas, if you will. Things like trend, mean reversion, relative value, how well this is doing compared to its benchmark. All these would be indicators, and you can have first order, second order indicators. Coming up, usually, like a lot of people spend a lot of time in coming up with more and more indicators. We think it's not very useful now, and in qplum, we have a strong bias against feature engineering. We try not to spend our time coming up with indicators, but we try to figure out what to do with in the process after that. So from the indicators, we have two deep learning modules. One of them tries to summarize these indicators. I'm talking about the DL model for returns. The output of this is a set of super indicators. Think of them as higher performance indicators, which will be used in our expected returns model. So we got some indicators to start with, and we are trying to figure out which ones are good and which ones are predictive. This is the DL model for returns. So in the past, with a linear regression model, the dominant method was subset selection. So find the set of indicators which are good. Find the subset of the indicators which are the best. However, in deep learning or a neural network approach, we take all the indicators, we try to summarize them, we try to shrink the dimension, or find collections of indicators which capture the essence of all the inputs, and yet are predictive, or yet are able to do a good job of predicting what will happen in the markets in the near future. Let me explain this better, and I'll go back to the workflow. We train a neural network with let's say, in this case, let's say 10 layers, where the initial layer, the cost function, is just reconstruction error. So initial layer is 100% reconstruction error. What does that mean? It means, let's say we have 10,000 indicators coming in, and the first layer tries to shrink it to, let's say, 2,000 nodes. We are shrinking in a way that if we were to expand back to 10,000, we would be able to reconstruct the input set of indicators. This is an autoencoder process. If your reconstruction is the only metric of performance you have, then this is what is called an autoencoder neural network. What it's doing is finding some sort of a meaning in these 10,000 indicators. It's describing these 10,000 indicators in 2,000 numbers, and I could progressively keep doing this. I could go from 2,000 to 500 to 100, etc. I could keep doing this and to find a more parsimonious description of my input set, a shorter description of what is happening in markets. But reconstruction is not my only measure of or wisdom. At the end, I'm trying to predict what will happen. At the end, for the 10th layer, the output of the neural network are these super indicators where they should have a high R-squared, high correlation to future returns. They should help me make money. They should help me figure out how to change my asset allocation. So the last layer, when I'm training the last layer, the weights, for my back propagation and the weights that I'm learning, they should all be learned to maximize my predictive ability. So there the cost function will be, or the reward function will be how well I am able to predict what will happen in the markets, let's say in the next 5 days, 10 days, or shorter or longer, depending on the horizon that I have. Okay? But between the first layer and the 10th layer, we progressively keep increasing the predictive part of the cost function and keep reducing the reconstruction of the cost function. Keep, if you guys have questions, keep asking. We'll take them soon. Okay. Apart from a deep learning model for summarizing indicators towards getting a better expected returns model, we have a separate deep learning process, deep neural network. It's a feed-forward neural network here to figure out the current market regime. Another way to describe a market regime is the expected risk. How risky do I think different asset classes are, different strategies are, how much correlation am I expecting between asset classes, all of that. Once I have these two models, the expected returns risk model, then we use similar to Grenoble-Kahn approach, an optimization or portfolio sizing logic. It starts with the investment mandate parameters. So this is where you would have your utility function. This will have your other constraints. Let's say I cannot leverage it anymore than 200%. Let's say I cannot go short more than 50% of my portfolio. Whatever are my constraints, all of that goes into this mandate parameters. And on a daily basis, based on the expected returns and risk model, we would come up with the ideal portfolio to have today. And this optimal portfolio box, I want to expand on it here because that's a whole different topic. But this is just one strategy. In this optimal portfolio process, or the systematic CIO process, we combine many strategies using this regime model. One description of one way to understand what we are doing there is that let's say economic numbers are very healthy and there's volatility in the market is low. Typically, this is not a good market for trend following strategies. Typically, this is a better market for relative value and mean reversion or sort of carry seeking strategies. This sort of factor should be used in allocating between strategies. So that's the systematic CIO layer, which we have in this green box optimal portfolio. But moving on, once we finalize a portfolio to have, then based on the portfolio that we had yesterday and what we want to have today, we would calculate the trades to place. And here, risk management and sort of whether we are in any drawdown situation or whether we're coming out of a drawdown, all that goes. Okay, so this is roughly the workflow. I see some questions. 1 second.
So just give us a moment while we're sure you guys have a lot of questions regarding this. So
so you have a cost function or utility function for each layer. Yes, Amit asked about having a different cost function for each layer. yes, when you're training a neural network, you can specify a different cost function for each layer. That's what we have, yes. Is stability of a model a concern? Like if you were to try a model from a past period or newer data, would a substantial difference be a problem? Stability of the model a concern? Like if you were to try to model from past period. Yeah, I mean, in general, this is kind of Malcolm, thanks for your question. Of course, stability of model is important. Like, I think the biggest problem we face in portfolio management, finance in general, is that future looks very different from the past. And overfitting to the past is the biggest problem we all face. We try to address that by walk forward optimization. We can talk separately about that. But yes, we constantly we score ourselves based on data that we have not seen, that the model has not seen while being trained, and if it does well on that data, that gives us confidence to keep using it. But you're right. I think a cardinal mistake a lot of quant funds make is they would try out a trend following strategy or risk parity strategy over the last 20, 30, 40 years of data and just assume that the next year will be the same as those years. However, the right thing to do is to try out a strategy in a way that its parameters are learned on past data and always tested on data it has not seen in a walk forward manner. Okay, Shrikant, why feed forwards versus LSTM? Thought you could carry state with RNNs. So Shrikant, you're asking about LSTM models or recurrent neural network models. The broad idea of how they differ from feed-forward neural networks is that they're trying to learn indicators as well. They're trying to learn the past sequence if I can learn a summary from that. For instance, in speech and semantic recognition, sort of understanding the meaning of a paragraph in those applications, RNNs and LSTMs have in general worked very well. In finance, I'd love to use LSTMs and RNNs, but right now we already have a good idea of how to use the past, in a sense, computing returns over a period, computing sort of correlations over a period, standard deviation over a period. We already have functions that we, as our human neural networks, have found. For us to find LSTMs and RNNs that do as well as those indicators and do better, it'll take us a lot more computation. It'll take us a lot more studies, and we'll get to that later. But I don't see the need to do that right now. I think FNN, feed-forward neural networks, over the indicators that we already had is the right approach currently. This is a good question from Lulu Meng. I'm sorry, what is a CIO? Sorry, I should have explained that. A CIO is a chief investment officer. He's the main person responsible for managing the pension fund. The main person responsible for growing it at the sustainability rate, at making sure it doesn't lose too much money. And just for an objective specification of the role, a CIO is often told broad contours of a utility function, that make sure you don't lose too much money. This is our sustainability rate. This is the target risk that we have, and within that, and maybe some idea of liabilities that we expect that that we will have to pay out claims at this rate. So all of that is specified to the CIO, Chief Investment Officer, and they have to figure out how to invest. It's not very different than you and I trying to manage our own money. Don Thomas asks, do you use the same objective function for optimizing each layer from a supervised perspective? Does it look at optimizing a single prediction, example, binary classification or regression? Is a reconstruction error and classification or prediction error combined in an additive fashion? Again, so each layer is optimized separately, and reconstruction error would be called unsupervised learning, and predictive, like optimizing against L2 norm or some form of some PNL related metric, would generally be called a supervised learning. So we are doing a mix of that. I think I addressed that in a previous question. Okay, lots of questions. Let's get back to the presentation, and we'll come back here. 1 second. Did we have a poll after this?
It's after 15.
Okay. So yeah, just talked about this. Let's look at some results. This is an illustrative. This is a product, a flagship investment strategy. However, based on a particular utility function of CIO or particular constraints, mostly our job is to customize solution for their needs. But let's look at one such customization, one such solution. It's a flagship portfolio. This invests in a lot of asset classes, equities, fixed income, real estate, commodities, and globally. It does through ETFs. Why? Because it tries to focus on the first goal that CIOs or pension funds would have, which is capacity. I want to run this in a way that I can manage my $20 billion portfolio, and for that I need assets where I can invest in them without making an impact to the market. And I think one of the benefits of the ETF revolution has been that it's become very efficient to use ETFs at the CIO layer. Okay, risk management. So this is our systematic risk management process. I think if there's one thing that Wall Street has done better than individual investors, it's risk management. During the crisis, I remember reading articles how Goldman's one thing Goldman did to survive the crisis better was risk management. Systematic risk management, where the risk manager has a lot of political power in the company, is very helpful. Because often the portfolio manager will tell you that, yes, I lost money, but I figured out why I won't lose money again. Or I'll, going forward, it'll just be positive returns. That might be, but as a risk manager, you have to sort of be dispassionate and be very systematic. So in this process that we have, this sits above anything that the portfolios do and anything that the strategies do, and this would deallocate. In this case, it would deallocate to 80% of the risk when we hit a 10% drawdown, then further to 60% if we hit a 12% drawdown, 40% if we hit a 15% drawdown, and so on and so forth. If we reach 20%, then it's completely in cash. But it keeps monitoring the performance of the strategy in sort of simulation. And if the strategy starts doing well, then again it allocates 20%, 40%, and progressively. After there's a cool-off period of, say, 30 days. I'm not going to reallocate again unless it's been 30 days since the last time I deallocated. Okay. So I want to show you some scenarios in which. Okay, sorry. Do you remind me? There's a poll after this. 1 second. Yeah.
So we will start our last and our final poll for this webinar, and just give me a moment while we have that up. And for this poll, the question is, what kind of risk management do you currently have for your investments? So again, we'll give you a couple moments to enter in your responses.
Okay. How do we show results?
We'll close this poll right here, and then.
Okay. Share results. Okay. I am impressed that 15% people have a structural risk manager. That's much more than I anticipated. I think you know, use of put option stop loss orders is encouraging. At least there's something. It's very hard to figure out how much to have. For put options, as you know, it's a constant drag on the portfolio. At times like now, where volatility is underpriced, it feels that that's not a big drag. But you know, especially during times of risk, when volatility spikes up, it's hard to stick with put options. Stop loss orders are great. Again, the hard part is to figure out where to stop the loss. And practically the you know, the largest segment here, 36% people, they don't have a structural risk management or any sort of risk management, which means that they evaluate things as they unfold. I'll be honest, prior to qplum, for my personal investments also, I was in this bucket. I would evaluate things as they go. I mean, who has the time, you know? But this is, I think, the biggest area where we can improve. So while there's this robo-advisor revolution and we are getting more systematic, if there's one thing we need to improve, and we can get more systematic, we can actually achieve, is being more systematic about our risk management, about pre-deciding a risk management that we can actually stick to for 10-15 years. And we shouldn't be cheating there. We shouldn't be saying that, oh, right now I don't need to worry about losses even if I lose 50%. That's not fair. Once you lose 20-30%, you'll not be saying that. But okay, let's get back. Okay. So for the flagship portfolio, I just wanted to show you that this risk management does get triggered. In the financial crisis, it drops down, allocation drops down to as much as 20%. But the interesting aspect is it increases back by itself to 100% allocation even before 2010 by itself. Now, if you look at fund flows, mutual fund flows data and ETF flows data, US investors as a whole, certainly they reduced allocation to equities during the crisis, but they had a long memory of the crash. Even till 2013, net inflow into equities was negative. People were still pulling out money 5 years after the crash. In other words, if you don't have a structural risk management, while it hurts on the downside, it hurts much more on the upside. It's hard to figure out when to put money back to work. Okay, so looking at some results, this is the time when it show upward sloping graph, I guess. But for optimizing for the utility function that we have, the flagship outperforms 60-40 allocation by a healthy bit. This in terms of returns, and cumulative return certainly looks like the effect is magnified. But if you actually look in terms of loss aversion, you can do it's much better than the benchmark. And you can try to do the same. You can, like, if you take the same data and you try to optimize it, learn a network. It doesn't have to be the most fancy network. Learn a network, try to optimize for a utility function that captures your reward and risk preferences, your loss aversion, your how much you would derive from gains, and I think you'll be able to come up with a portfolio customized to your needs. This is the right comparison, in my opinion. This is how Flagship compares to the US Investor Index. Here, the volatilities of both these are very similar. The drawdowns are very similar. The maximum drawdowns are very similar. And of course, it's an upward sloping graph, and we can feel happy about that. But I'm just trying to show that there's a lot of opportunity compared to what an average US investor did. This is the orange line here is the performance of US investors as documented by Federal Reserve. The data is directly from Federal Reserve data, and we have just worked with it to come up with the performance of a net log return number for investors. So over the last 20 years or so, US investors were able to almost double their wealth, to roughly around 200% return. There was a deep drop in wealth in the crisis, and till about 2013, late 2013, they were able to make back that amount, that loss, from purely investments. Here I'm not counting the money they earn from employment, etc. It's just purely investments. And we have a lot more data on, if you search qplum US Investor Index, you'll find a lot more data on this. I think it's, on a separate point, it's very important for us as individual investors to compare against the US Investor Index and not against S&P 500 or some other index that does not properly capture the the volatility that an individual investor is comfortable with. This is an example of the asset allocation, how the asset allocation changes over the years. And you can see how over time, based on, like for instance, in the crisis, the allocation to equities drops a lot, allocation to fixed income increases, and you can see how allocation to real estate also changes over the years. Yeah, that's about it. And our goal here is to carry forward the work that I think Benjamin Graham describes well, is that security analysis, which for him was investing, may begin modestly, but hopefully to refer to itself as a scientific discipline. Now, all of this work people have been doing for a while. It's just that they used to do this based on intuition, based on what their read of the market is, based on a lot of quantitative analysis that they would broadly classify as intelligence. We are trying to, at qplum, we're trying to say we're not smart. It's not like invest in this because we are smart. We are proposing methods that are a scientific way to achieve the goals that the investors set for themselves. And the science here is a social science, it's an adaptive science. It's not a pure science like physics, etc. That's why a deep neural network approach lends itself very well to this adaptive environment. Okay.
So we still have a few moments before the session is up, and what we'll do is we will cover all the other questions that we did not get a chance to go over earlier.
Okay. What is so Lulu Meng asks, what is ACWI AGG? Good question. ACWI 60-40 is a 60% allocation to ACWI and 40% to AGG. That was the context. So ACWI is All Country World Index. It's one way of saying investing in global equities. MSCI ACWI, if you search, is a popular benchmark used by pension funds for their equities allocation. Sorry. And AGG is the Barclays Global Aggregate Bond Index. It's again one way to measure the performance of a bond investment investment in fixed income. An improvement on this would be 60% ACWI, 20% AGG as in US bonds, and 20% global aggregate bond index. The results won't change, but I'm just in case you want to work on it yourself, that's what I would do. Okay, Michael Klein, so you're saying that structural risk management tends to overvalue ETFs and other existing investments, probably because assets you already have are better indicators for your particular portfolio. No. So my point about structural risk management was not about what to do in the portfolio. No matter what strategy you have, if it's index allocation to S&P, if it's trend following, risk parity, whatever strategy you have, final layer should be a structural risk management. Final layer should be a heartless risk manager who just looks at the drawdowns and sees if the drawdown exceeds the thresholds, then cuts the allocation. And similarly, if the returns have started growing positive again, and since if you are doing well, then it increases allocation. There should be no perception, like there should be no debate. That should not be left to argument. That part should be, very systematic. What I'm trying to say here is that use this structural risk manager in the construction of the portfolio as well. So don't just find a strategy that looks great. Find a strategy that looks great under your structural risk management. Okay. Priyank asks about data pre-processing. How do you take care of the difference in the number of samples of each feature of the input layer? For example, a particular feature may be quarterly profits for a particular equity. Another one might be a daily data. A very good question, Priyank. And it's a huge problem once you start working with the data. And I think let me explain it this way. So suppose I ask you to make an estimate of what will be the next GDP number. You will use some data that is monthly data, you'll use some data that's daily data, and maybe you'll use just past GDP estimates, it's quarterly data. But you'll finally come up with an estimate that is changing every day. So one pre-processing is that you use your data at different frequencies and come up with an estimate that gives some allocation to all of them, but assumes that some of those values are changing, but I just haven't observed them. You could generalize this to the same ideas are used in Kalman filters, and so there are observed variables and unobserved variables, and you have to sort of model how the lower frequency data points are changing as well. So you make your final inputs would be unobserved variables, and your unobserved variables would be changed based on other observations. I don't know if I did a good job of explaining this. Okay.
So I think we'll have time for
one more
question, right?
Okay. So Barry asked, what programming language do most of you work in? Barry, most of the analysis we do in Python, but the final execution layer, the latency sensitive part of it, is all written in C++. Some parts of it are also implemented purely in hardware, like using FPGA. Okay, that's about it. Yeah. How do I? So thank you everyone, and please send me questions or anything about slides, if there's any point that you want to go into more detail on.
And just a reminder for all the attendees here in today's webinar session, if you select handouts, you can go ahead and download this PowerPoint presentation for today's webinar. So at this point, we'll pretty much give it back to Cynthia. And thank you so much, everyone, again, for joining us.
Well, Gaurav and Ji-Chen, thank you so much for today's presentation. And I do see a couple of questions asking if this has been recorded. And we are recording today's event, and we'll be sending out a link to each of you with today's playback. So if you do want to come back and review those concepts Gaurav went through today, simply watch your email for a direct link to that recorded playback. And as Ji-Chen mentioned as well, if you would like a copy of today's slides, notice that in your control panel there's a handouts title bar. Simply double-click to open that up and you'll find a PDF copy that you can download locally to your machine. I will leave that up for an extra couple of minutes for those who do want to download and access today's slides as well. So with that, we are going to conclude our event today. I want to thank qplum once again for a terrific presentation. And I want to also thank all of you for taking some of your day to attend. We do appreciate your interest. You can all exit today's event using the X in the upper right-hand corner of that control panel. That will allow you to exit today's session. So once again, thanks to all of you. Have a great afternoon or a great rest of your day. Thanks, everyone.